the presentation tonight, we wanted to talk about peaks and peak formations. Okay, peak formations, what causes them and why? All right, ask yourself this question: what is the market maker's sole rule? If he has one rule, what is his rule? Go ahead and type in your response. It's okay, Taji. We were waiting for you, buddy. Yeah. All they see is money, 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 money. Okay. Some people are already answering how he's going to do it. I didn't ask you how he's going to get the money. I just said, what is his sole rule? His sole rule is to take money out of the market. And many people are personalizing it to take my money. Yeah, to take your money. Anybody who has a trade on hot with a broker, I'm sorry. That shark smells your blood in the water. Okay? Blood in the water. It's fine. All right, so good response there from everybody. Yeah, we're going to go into what that is and how he does it. All right. So to be honest, he's hitting the stops to make instant money. All right, that's really what he's doing. He wants to hit the stops and make instant money. A stop loss in the market, if he grabs that, bam, it's instant money in his account. It's not like holding float both directions, because you can hold float through pullbacks, and then the price can turn in your favor. As soon as he hits a stop, that's the end of a trade. That's actually money coming out. So he's wanting to hit the stops for instant money. Now, what is the three-step process that he uses that is the reason for these peak formations? Anybody want to type in there? 3 simple words. Car's gone over it a jillion times. All right. This is why I love going back to the basics with this stuff. It's absolutely vital. Okay, there you go. Clive's got it. That's actually the perfect wording. John Ford, Patricia, a lot of you guys have been hanging out for a while. You new guys, bear with us. I hope to make it interesting for you guys who got the correct answer. You're right in there. All right. It's more than just 3 times. It's more than 3 pushes. It's actually a little different, the answer I was looking for, but let's go into it. Induce traders into positions. Okay? Induce traders to emotionally believe in a trend. That's his first objective. His first objective, which we could see is the left side of this peak, is for him to get people emotionally believing in a trend. He'll use the news. He'll use a huge long move, multiple days. He'll get people emotionally excited. So his first objective is to induce people to emotionally believe in a trend. All right. And see here. Second thing he does is to trap traders into taking positions in line with the trend he is 100% responsible for creating. So he's created this trend. Now he wants to trap them by pulling back in line with the trend, actually in the opposite direction. And he's responsible for making this trend. So what he makes, he can break. And it's way, way cool when you can get your brain out of the technical analysis type of view of the market, this pervading view that's peddled by 99% of all trading coaches and all that. There's some technical reason stuff is happening. There's no technical reason happening other than the dealers there making and breaking the market. Okay, it's very important to get that through your head. We use the illustration of an F-16, any plane that's fly-by-wire. The computer is responsible for keeping that plane up. Okay, it's not the mechanics of the pilot. He's putting inputs in, but the computer is doing all the moves. Same thing with this. The market maker is responsible for it. Great to get your head around that. And last, of course, he shifts away quickly from this trap to trigger the stops of those who were so induced into those positions. So that creates this quick pullback off of this peak. That creates this shift away. All right, so the correct answer is induce, trap, shift. And there's 5 or 6, actually a little more, about 7 or 8 of you got this absolutely perfectly correct. That is what it is, induce, trap, shift. If ever you were going to replace all your technical analysis with just one little menu of things, replace it with this. There's no indicator that's going to tell you when he's inducing. Okay, there is an indicator that gives us a sense, a hint of when he's trapping. That, of course, would be our TDI. And there is no indicator for saying what the shift is. Sorry. There's a whole lot of crap in between that you can get your head mixed up with when you really should be looking at this. If you look at this in your studies of charts, in your real-time trading, you're in a much different position than what has been taught to you before. Much, much different. But remember, it relies on the premise that we brought out last DMR, that the dealer is responsible for the move to the market. That's the basic premise. That's why we did that entire presentation last week, to just drill that one idea in there. Yes, he's there. There's a shark in the water. As soon as your trade goes on, it releases a little blood, and that shark can smell it. All right, let's go through this, each one, okay? Induce, trap, shift, you guys all got that nicely. Now, isn't it interesting that these three show up in these simple AFP rules that I've been presenting to you guys for well over a year now? Induce, many days of rise. Trap, multi-day M or W pattern or single spike. Didn't write that in there, but that is also included. Close day beyond 50 pips. There's the shift. Okay, so when you're looking at AFP, when you're looking at a completed peak, that's what how Martha says it. She says it's a pick formation. All right. When you're looking for a completed peak, you need to see an inducement, you need to see a trap, and you need to see a shift. The shift actually is what gives it away most of the time, because remember, the dealer's going to do the traps differently each time so people don't catch on to it. His inducements pretty much look the same, but the traps are all going to be slightly different. It's really when the shift happens that it's like, ah, I see what he's doing. Okay? And oh my gosh, that does match up with our AFP rules, are right in line with these three. Isn't that interesting? Okay, so our basic premise is that the movement of price in all structures formed are due to the interaction of the all-powerful market maker and the impressionable herd in reaction to him. It thus seems wise to create simple rules which mirror what he is looking to achieve. So that's why I'll personally use these very simple AFP rules from here on out. The more stuff I bring into it, the more I might fall for one of his variations. If I keep it very simple, like this, I can pretty much see the 4 or 5 pairs that I'm interested in trading. AFP. Okay? That's pretty much it, straight up. 1, 2, 3. These are the 3 things. Induce, trap, shift. Remember that. Okay? Peak formations, what's the cause of them? Right here. It's a peak formation is the 3 of these all operating as one unit. Okay? And of course the why is to make money. That's the why of it. No question about it. All right. Let's try to look at it from his perspective, as he has the added ability to see all volume present. Okay, all-knowing, all-powerful, all-present. Sounds familiar, right? It's very interesting for all you guys who study metaphysics, or even people that are theological. It's the same concept, right? It's all-powerful. Interesting. That came out to me when I was making these. I was like, wow, that's something to keep in mind. And it's actually true. You need to have that basic premise when you examine your life from the content of character and things like this, but at the same time, in dealing with the market maker, you have to see him as all-powerful. It's actually the truth, right? But, and very similar to metaphysical things, you will never have the ability to see him or this volume. You must see all of this by inference. Inference means, by example, you'll see the footprints, you'll see the shadows, you'll see things that imply what he's doing. You'll see all these things as an inference of this volume present. Remember, from his perspective, he has the added ability to see all volume present in the market. We can't see that. We will never be able to see that. Okay? Just get that through your head. All right, so when we're starting the cycle, volume long in the market and volume short in the market are relatively balanced. Okay? And he starts making his first move up, still have a relative balance. Note that the volume is quite low. Might be the beginning of the week, right? Volume is quite low. As he gets up in his move, as he creates his second push up here, long traders, momentum traders are starting to get into the market. Okay, notice that the aggregate volume is starting to build. Okay, now, as price rises, we do have reversal traders getting in early. A lot of people like to catch the falling knife, as it were. And so as he hits the spike up, it triggers further orders long, but it's also getting people interested in short. There are a lot of people that take these reversals with nothing to the left and without knowing anything. It might be a reversal indicator, those bands. Any type of indicator that has bands is going to be firing up, trade short, trade short. So now you see more volume is in the market. This is typical of level 3. Level 3 has the most volume. Okay, there's more volume short, there's more volume long. Now when we say volume long and volume short, remember, what we're doing is we're trying to see through his eyes what his perspective is. This is something that he sees. He sees I have a certain amount of long orders here, I have a certain amount of short orders here, and I'm using the green for the long orders and the red for the short orders, And the bigger that these boxes are, the more volume is present. And I want to show you how he works level 3. We've done this with level 1 before, but I wanted to walk through level 3. Okay, so again, band type indicators are signaling short. When those guys get, actually, let's talk about the breakouts long here. First thing that happens is a lot of people are taking momentum longs. And when they take these momentum longs, they put their stops in the range. A lot of people do that. They do a nice tight stop. Remember, this is a 1-hour chart. On the 15-minute, this might be at the bottom of a previous candle. So as price is running up, longs are coming in, and they put their stops close into the range. And that buildup of stops is hit. He comes back down and knocks those stops out. A little bit of the long volume leaves the market. See that? Went from big to small, right? And as he hits each one of these stops, the long volume is now taken out of the market. Remember, we had people going long here. So in the first part of his level 3, it's most likely that he's in a relatively balanced position still by the time he does his pullback. He's merely hit the stops of those who went long here. You guys that trade the bands and all that got a nice trade back to the previous trap area. So they work some of the time, but you won't get the big run that you might be expecting. So those guys did all right, but the trades long got their stops hit. Okay, some of the herd will chase this. Right? There are people that will chase these extreme moves, and so we'd have to say that short orders start building up. So we have some more short orders coming into the market. Remember, the dealer's probably seeing all this information as telemetry on his screen. And really, it's the stops that are the most important part, though. Volume in the market now is slightly net short. You can see he's a little more net short than he is long. And also remember, the dealer has paid to make this ramp in price. He paid to move this market up in 3 bursts like this. That comes from the dealer's own pocket. So he'd have no reason to reverse out of here with this particular balance because he's got more people short than he does long. Hope you can see that. I really need you to see that. He's seeking to create an imbalance in orders before he makes the shift back down. He wants to have a majority of people trading the wrong direction, so when he pulls against them, he can hit their stops. And he can bring price back down and recoup his investments. Or just take this money out with 0 loss, and his profit are the stops. That would be the logical way that a market maker would work, that he'd use other people's money. He'd use the aggregate bank money that trillions afloat at any given time. He'd just make sure that comes back to 0, but at the same time he gets to take all the money from the stops. That's the way I would do it. Okay, I'd make it transparent, so I use other, whatever the money is that I'm creating hedging transactions with, etc., and then not rely on that actually making a profit. That gets back to 0, but I make a profit by hitting stops. And that's where it makes a lot of sense. And his price action actually confirms this. He also wants to see, and here I go into it, the availability of stops in the market to make his kill shot or shift against the longs. He really wants to see stops built up and at the same time have the imbalance so that he's getting paid on the way down as well, or in the case of my theory, that he's actually bringing all that money that he used to push the market back to 0, so the people that make the withdrawals the next day have all their money there, right? So it's a typical idea that a bank has an aggregate of funds. What they do with it overnight, we don't know. I believe that they play with the Forex with it. Big part of it is that. All right, so he also wants to see the availability of stops. He's constantly looking for these stops. Again, you will never be able to see this data of aggregate stops current in the market, so you will have to visualize the backside of the screen along these lines. And this is actually the most important reason not to have too many indicators and not to be an indicator-dependent trader, because guess what? The indicator inside your intellect, with the knowledge you've gained, has to see this kind of stuff and project this out. It's going to help immeasurably. When you get this aha moment, it's crazy. It's really amazing when you get this. You realize how rigged the market is. Okay. He has more volume short than long. What is he going to do? It's pretty obvious. If you have more volume short than long, which direction are you going to go? What do I mean by backside of the market, Scott asks. What I mean is his point of view. If you were a dealer and you were looking at price and volume and stops, what is he seeing that is behind, as if you're the dealer behind the screen? What I mean by backside of the market is his point of view. Not the trader on our side, but from his point of view. That's what I mean by backside of the screen. Okay, So remember, we've got these momentum traders that saw this pair dropping. They started going short, and as they go short, you can see they put the stops in the market. Now, I know some of you guys have seen a lot of those indicators sold that represent that they can show volume. I don't buy it. There is a certain amount of volume to be seen by tick volume, but that's not real volume. The dealer may see stops with the longer lines having more volume. Okay? He has something on his computer screen where he can see where the stops are and how many stops are there, what the volume of stops are. It might be something like this. I've often tried to visualize, put myself in his place, what is he seeing and how, and it would make sense that he'd have stops that would very simply show very simple telemetry on his screen that indicates the amount of volume in each one of these stops. So we're going to just hypothesize that that's what he's seeing. So he comes up and rips right through those. These guys that went short got taken out. All right, so buildup of stops hit. Now we're starting to see typical behavior of level 3, and this is why he's playing with each one of these. So as these stops are hit, short orders are taken out of the market. Okay, buildup of stops hit. Each one of these areas is an aggregate of stops that are hot in the market. He takes them out. At this point, he's confirming the lightning bolt-based patterns, and long orders are coming in big time. This right here, lightning bolt pullback. Okay, and this brings me to an interesting dealer sidebar story. I don't have time to go into it. So we'll save that for the next time. I did find an interesting book. This predates probably most of the typical psychologist that everybody studies. His name is Gustave Le Bon. It's a French title of a book called The Crowd. And I'm really interested in checking this book out because supposedly this is the granddad of crowd consciousness and how that whole thing works into psychology. I'm going to try to get a copy of this and cruise through it. It's called The Crowd by Gustave Le Bon. Very interesting. We'll go into that sidebar of the dealer another time. It's a good story, though. Okay, so as people are seeing this lightning bolt confirmed, the crowd starts loading in big time. So now you have a lot of people long, fewer people short. Okay, he does his pullback, creates his railroad track. Some of the long orders have their stops close in. Right, they have them in the range. Some put their stops outside of the recent range. Okay, some guys are going to put their stops here. Others are putting their stops tight. Of course, what does the dealer do? He comes down and hits those stops, takes them out of the market. Buildup of stops hit, pop. Buildup of stops hit, pop, take it out. You can see the long volume is starting to get smaller. And of course, these traders, happy their stops were not hit, put yourself in that position. Remember what it's like when he does a pullback and your stops aren't hit. Makes you more confident that you're right. All right, so happy their stops were not hit, they keep their long positions on. Oh yes, we're going with the crowd. It feels so wonderful. All right, we're still long. We got our stop below the range. We're smart. All right, so some members of the herd chase it again, and some short orders build up. They see this price coming down, so they'll chase short. Volume will come in. Market maker waits for the aggregate information from all sub-dealers. That includes basically any dealer there is. They all have to go through clearinghouses. Everything eventually gets in his mitts. And he waits for it all to hit his platform and sits back to see and sees at this point that there's no exploitable imbalance yet. So at this point, he's looking at his platform. He's going, I've got a certain amount long. I've got a certain amount short. They're kind of balanced. I'm seeing an aggregate of stops down here. I want this stop to be much bigger, and I want to see my longs much bigger. So he's taking in the entire scene. Okay, he doesn't have an exploitable imbalance yet. All right, now we've all watched this. Sometimes the Forex will do a big move and then it just sits there. Then it'll sit there for an hour and do nothing. Then you get a burst of move and then it sits there and does nothing. Then it bursts again. Okay, this is, in part, him waiting for the aggregate of information to hit his desk so he can assess where he's at in the big picture. All right. And wildebeests will be wildebeests. And again, some members of the herd who just entered shorts put their stops inside the range. So again, people are thinking, oh, it's coming down, I'm going short. Remember, momentum traders are constantly trading this thing. Put yourself in the position when you first looked at a chart. The best trades you thought were when you get momentum in a certain direction. Right? So a chunk of people are doing that. They're putting their stops inside the range. Pity them. Right? Okay? That's basically it. They're follow the first guy. Right? Just follow the leader. All right, and that's okay. They've been taught that. All right, build up stops hit 1, 2, 3. Now you can see these short orders are starting to become smaller. We still have the people that are holding long with their stops down here. Now we're starting to get this imbalance that the dealer was looking for. Again, retail trend trading systems fire off orders long. So right here in this pullback, retail trend trading systems are like, this is great. It's the pullback before the rise. All that confirmed stuff is going on. Yet the dealer now has more long than he has short. Okay, it's taken him an entire day to do this. Okay, he worked an entire day up there at level 3 to create this very situation. Okay, now their trading systems fire off, so all these guys are going long here. Even the guys that got this right, that had their stops not hit, are like, okay, I'm adding in. It's going in my favor. All right, so you have people adding in at this level. And of course, some put their stops in the range, and some put them outside the range. But guess what? This stuff starts building up and looking so yummy that the dealer starts to, well, I guess the shark smells blood. Okay? He knows there's a big bunch of stops sitting right there, and he can see it on a screen. Perhaps these lines get wide when there's more volume. I'm not sure. That's the way I would do it. Okay, so the dealer pulls back off that high, and some of the stops are hit, the ones that are inside the range, right? We've got those taken out of the market. But at this point, the dealer is using time in his favor. Okay, I want to explain this. This is a very interesting key component. It's very relevant at level 1 for away from peak trading. He just sits there waiting for orders to come in long as people think, because it's not dropping, it must be going up. Besides, my trading method says go long here. So the guys that were confident, that didn't get their stops hit, that added in at this high, endure this pullback, they're like, oh, it's a pullback. I can probably get a better price here. I want to go long again. All right? So the fact that he's just sitting here confirms all the garbage that's been going on previous. All right? He uses time in his favor. He's not going to shift this until he's good and ready. So what does this do? Since the retail world sees this as long, even more orders come in. All right? So now we're getting the real big imbalance. Okay, the market maker makes his last-minute scan of the aggregate data across his sub-dealers and assesses the stops which are currently in the market. Now he's really got that technology to go look and see where these things are. Where are the aggregate stops in the market? He sees all this volume down here. He's got a ton of volume built up long. If he comes down here and hits these stops, he'll probably come back into balance, or even better, he'll still have more long than short. All right, now I hope you're seeing this. This is important to see on the other side of the screen, as we say. We want to see his perspective. This is why level 3s take so long to form and to pull back. It hasn't even shifted yet, and it's been a day and a half. All right, that's the way to look at level 3s. They're not going to be able to create this imbalance right away. He's got to work it. He has to oscillate. He has to do these big moves. All right, it's a place where the most volume is, level 3. All right, so then he finally comes down, knocks into this first set of stops. Boom, long volume comes out of the market. Short volume starts to come in. Remember, as the market is turning over and as it's shifting to the short, you have momentum traders that are going short here. So you always have to keep this real when you're looking at this perspective. He comes down, he hits this next set of stops. That takes a chunk out of the market. Some longs are taken out, and some shorts go in. Then he comes down, he knocks into the next set of stop losses, right? Boom. Longs come out of the market. Some shorts come into the market. And then he finally comes down and hits this last bit, and longs go out. And notice the buildup of shorts now starting to create the imbalance. Now this pullback that he does after this shift, and in level 2, remember we're in level 2 here. Actually, no, I'm sorry, we're in level 1 here. I'm jumping ahead of myself. We're still, this whole thing is in level 3. All right, so what he does is, as he shifts out, he's going to do a pullback because of this very thing that happened. Now he's back into a balance. He wants to create the imbalance. And what he does is he goes against anybody that went short at the end of this trend. Remember, there are a lot of people that see this big trend down and take that short, and he pulls back against them. Now, what just set up on this 1-hour chart? This is a 1-hour chart. Steve used this in boot camp last night. We just walked through all this. What just set up right here? Type her in there. There we go. Well, yeah, we're not saying safety yet. Now, what I wanted you to say was AFP, away from peak. Level 1 would be a correct answer as well. Okay? What just set up here was a perfect confirmed level 1. Why? Many days of rise, trap structure. Oh, I think I draw it in here. All right, AFP, baby. Days of rise, multi-day M formation, CDM, big M, right? and then consolidate and close end of day at the extreme of structure. We're definitely 50 pips off the high here. Okay, super simple. 3 things to look for. This tells you that the dealer has done his thing. All right, you can pretty much assume that if he's invested the money to take it all the way into this steep trend and created the trap formation and pulled back that far from it, you can pretty much bank on the fact that there is an imbalance current in the market. Okay, he's ended the day, but there's still more longs than there are shorts. Very important for that. Okay, here was our induce stage. This was our trap stage. This is our shift stage. Okay, notice though that the market maker still has an imbalance in his favor after this initial trap at level 3. Okay, at this point he has some area of price he will not exceed in order to maintain this imbalance for the drop only he knows is going to occur. Oftentimes his line in the sand is near a previous trap area, as he may have induced more longs with this move. His objective is to make sure there are more longs than shorts if he wants to come back down. Okay, now he wants to build this back up. It's obvious to a thinking person, given our basic premise that he runs it all, that he as well plans his approach ahead of trading sessions. He perhaps comes on at 6 p.m. and he doesn't look for many days of rise, trap formation, and shift. He knows that. He's already done that. What he's looking for is how much do I have long, how much do I have short, and where are the stops on either side. And of course, where are the pending orders, where are the breakout orders. There might be a breakout order just on the other side of this pin. All right? There are some people that move their stops as this pulls back as well. Right? So they hold the long. So he's sitting down and he's analyzing the new day from his perspective. It makes total sense that that would happen. So the question I ask you is, does your own personal check down to some degree reflect how he's seeing it? Yes, it does. That's the whiteboard. Okay, that's what Steve's been showing us the entire time. Make your check downs that simple. Then you're looking through the perspective of induce, trap, and shift. Okay. So he comes out the next day. Also consider that some number of traders have moved their stops to absorb the drop. Yes, they've moved their stops and are going to average in long again. Okay, absolutely. To many retail traders, level 1 looks like a pullback before resuming the uptrend. Very big, important point. This still looks long to a lot of people, and this would have, I'll get into my dealer sidebar story next week, but that will play into it quite a lot. All right, at this point, the dealer uses vector to induce these traders to place long orders. Guys that are already confident that they're just in a pullback, they might have moved their stops, they're invested in the market, they still have longs. Those guys will get induced with this move. What is vector? Vector is speed and distance, both speed and distance. We don't want just a little tiny candle speed up. We want to see a big fat one fast. That would actually be vector. Correct explanation. And we get that. Love it. All right. To an AFP trader, this move gets you very interested in trading this pair. Very, very interested. It is the exact time that the beloved revenge traders start entering in long again. Think about it. If you put a lot of orders long and you got stopped out as this thing was pulling back, you come in the next day, you're like, oh, okay, now he's going long. All right, put yourself in the position of you early on in your trading career, that lovely revenge trade. Okay, I lost 5% of my account on this move. I'm gonna put 10% risk on this time. I'm gonna double up on it. That is how they trade. All right, and guess what? Those revenge traders are now adding to the longs. Ooh, man, he's really getting a bunch of longs up there. After getting stopped out, the average monkey will pile in with even large size. I don't say that in a degradatory manner. We are crazy people. A portion of people are crazy. The herd mentality, all these things. Some people trading this market are trading like a monkey. I'm just going to say that. And I would say that with total confidence that I was once a monkey. All right, so I'm not trying to be highbrow about this. It's actually true. I traded emotionally for so long, not knowing this. All right. So there he goes. He triggers a breakout, and he pulls back a little bit. That brings some more long orders in. Dealer hits the previous trap area and closes back beneath it, as he likely triggered some breakout long orders at this point. Boom, orders come in, more long orders. As well, many shorts that entered are getting their stops hit. Guys that thought this trend was going to keep going down, all their stops are in the range. They get hit, bam. Now you can see a real nice imbalance here. He continues working the area using time to lure retail traders into longs. All right, so he'll sit up here however long he needs to get the exact imbalance that he's looking for. All right, remember, he will sit there and work it until he has the desired imbalance. Okay. Now, a lot of people are getting long because they're seeing it sit there. If it's not going down, it must be going higher. Right, that type of mentality. He comes and he creates this second leg. He pulls back and hits some of the stops of the longs here, who place their tight stop into the range. Yeah, he does that, and that pulls out a certain amount of volume. But he's also given people that lightning bolt pattern again, the famed M pullback. There's probably a fib number in here as well. People are like, oh, it's definitely going long. But he brings in yet more long traders as he makes his fast move back into the highs. Each one of these pins was a fast move, fast move, fast move. Okay, so that brings more traders long. All right, again, he waits for his sub-dealer aggregate of data showing where the stops are placed. Then the market just sits. Also, for him to accumulate information. Okay, now the information comes in. He's like, okay, I got a certain amount of stops here, certain amount of stops here, certain amount of stops here, and a ton of stops down here. Right, so he knows how many there are, how big they are, and what his next objective is he plans to hit these as fast as he can so there's little time for traders to move their stops or adjust their positions. He doesn't want people reconsidering. Right? He wants to also recoup his investment from the initial multi-day inducement retail trend with the stops as quick profit in his pocket. Think about it. If he's using money to move the market up, he's going to bring the market back down. That money really never changed value. What he got was the hot float in the form of stops in the market. That's the hot money. That would be, if I were a dealer, I'd be looking for stops. No question about it. All right, wham, he hits it. Just instantly. Look at this shift compared to the level 3 shift. Much faster, much more intense. He sat here for a little bit to reassess. He got a new feed of the stops, and then he hit it again. Very, very quickly, within 3 hours, he cleared the whole board. Boom. All right? Or cleared a portion of the board. So outgo stops at the first level. You've got less volume long. Outgo stops at the second volume. Even less volume is now in the market. Stops are hit again. Now remember, momentum traders are starting to come in, so now we start seeing the short volume building up. He hits this next set of stops, long volume taken out of the market. Short orders come in, build up, and he gets this last area of stops where the granddaddy was. Bam, takes out a ton of the market orders with that move, and some come in short again. So now he's back to balance. Now, keep in mind, and this is what's so great about AFP and level 1 trading, keep in mind that a lot of volume has been taken out of the market as it was entered both at level 3 and at level 1. Remember, some people will move their stops and they'll endure this whole thing and they'll aggregate long, and then they'll finally get their stuff handed to them as he shifts out of there. So some people entered here, some people entered here. All right, now we come back to balance. Some of the herd will chase short as well. So you've got a buildup of the shorts here. A lot of people are chasing this short. Of course, he handles them by pulling back into the range, right? Takes some stops out. He takes it back long again to stop out those of the herd who chase the lows. Boom. Takes them out in 3 areas where the aggregate of stops were. All right, so balance of longs and shorts is reestablished. Now he's back to balance. Now the money that he used to make his ramp is paid back to whatever sources he used that money from. As far as people know, they get their 1%. Yeah, he's made a real nice killing off of hitting all these stops. All right, market maker then goes into another pair. He might have another pair right now entering level 3, and he leaves the market participants to drive the market at level 2 in this pair. Okay, so he's not going to mess with the volume too much in level 2. It'll play out. All right, just chop sideways. Okay, then he comes back in. Then he steps back in and starts to create the inducement into level 3 again, starting the cycle over. All right, so now he starts to invest short. Okay, to push this market to make this trend work in his favor. Okay, so that is a completed cycle on the back side of the screen from his perspective, right? And it happens over and over and over and over and over again. This really is the crux concept to get in your minds for understanding what a peak formation is, why it's created, and how it's created, so you can exploit it. Yeah, I love the story too, Patricia. Every time I do this, it gets better and better. I had not done this at level 3 before. So walking through level 3 explained a lot of things. Why is there more volume? Why is it madly oscillating? Why does it sit there so long? Why doesn't my level 3M pull back right now? Why do I have to wait a day or two for it? And all these things are answered in terms of looking at it this way. All right. And of course, because we took our time here, we don't have time to go through any of the trades from last week, but please avail yourselves, especially you new guys, of this lovely WSM map that's available in the DMR section of the forum under the WSM study module, weekend study module. The map is showing you where all the best of the best trades happen, and I encourage you to go look through these, look through the top AFPs from last week. There were 5 of them. As we get on through the cycle, I'll start going through these more and more and more, and we'll look at these on the hard right edge together. But I did want we spent a good amount of time on Paul's trade, so that's cool. 22 trades, of course, are up here. These are the 22 trades that look to be the best of the 22 trades. And then New York reversals, throw about 3 of those in a week. Go look at these pairs on these days in these sessions. So the way this is it's pair, pound Aussie, the day that the setup happened, Monday, the session that it happened, London, and then the date. So it's identified for you. You can go back and look at those setups from last week and see them on the hard right edge with our upcoming WSM viewer. We'll have that out around February 1st, and that will allow you to see how this all happened on the hard right edge, and hopefully you'll start to incorporate in your check down and in your trading what is the volume that he's dealing with. Are there stops that he's hitting? Does it look like there's an imbalance in the market? Induce, trap, shift. Okay, so that's what you want to be looking for. Think about it in your studying as the week goes forward. We look forward to working with you tomorrow in the pre-market session. Remember, 7:45 a.m. East Coast time, I get on to have a look, overall view of the market. I try to get where pairs are in terms of levels. I look for away from peaks. I try to incorporate all this into real time. Okay, so if you haven't availed yourself of that 7:45 a.m., you should get an email link before the session. You can come hang out with us for about a half hour or so, and we look at the charts on the hard right edge. All right, and always feel free to pop in questions, even though I'm not answering them. Just know that I always save the queue. Okay, so I'm going to save the queue right now. Save questions log. A little window pops up, and then I can save that. And your emails are all attached to that too, so I can go back after the fact and look at questions and pull that type of information for everybody's benefit. All right, guys, it's great to work with you as always. There's never enough time to get it all there, but that's all right because we're headed in the right direction. Our compass is due north, and we're sailing. All right, guys, you have a great rest of the evening if you're in the United States, and a good day for you guys in Australia, and we'll